everybody. Good evening. I have to do this one because there's so much going on in the marketplace right now, and this is front and center. We haven't talked about this for a while, but what were the big things today? Well, the NASDAQ closing all-time high. I think that would be front and center. PPI report that came out this morning, CPI coming up tomorrow. You think that would be front and center, but no. Here we are. It's almost like 2020, 2021. Part two with the meme stocks. Yes, they are back. How long is this going to last? I don't know, but it is pretty crazy right now. And, for those that didn't go through it the first time or don't really understand what a meme stock is, the craze is getting going again. So what exactly is a meme stock? And a meme stock, it's really about the buzz that's created on social media about a company. It's not talking about a stock like a Nvidia. It's not talking about a stock, a boring old stock like Apple or Chevron, or really about valuation. It is not about valuation. It is not about fundamentals. Meme stocks, they're really defined by the popularity on social media as opposed to generating earnings, generating revenue. So it's almost like, what is the latest and greatest, right? What is the biggest in fashion right now? And again, what happens is with these meme stocks, and we're going to talk about GME, AMC, same ones that, we talked about 3 years ago or so. It's not really shareholders getting together, but once something starts on social media, whether it's through Reddit, Wall Street Bets, whatever it is, it's really like a snowball effect. And as word gets out, honestly, other people are joining in. So as a quick history, this did start back in like 2021 when there were a lot of day traders that came into the marketplace because of COVID, the lockdowns. So people were sitting at home and they were trading. And we all know what happened to a bunch of these stocks here. We saw stocks like GME and AMC, BlackBerry, Bed Bath & Beyond, just stocks that had massive short amounts of interest in them just skyrocket. And really for no reason other than the momentum that we saw on social media. So it's happening again right now. How long is it going to last? I have no idea. But what I want to review real quickly here is some of the option pricing, which is just absolutely crazy. We talk about implied volatility of an option, and really implied volatility is directly correlated to how expensive an option is. Think of implied volatility as supply and demand. The more supply there is of any asset out there, prices are down, right? The more demand there is, no supply or short supply, prices go up. So as these meme stocks have kind of triggered all the rage again, implied volatility, as you can see on the screen here, has skyrocketed. Absolutely skyrocketed. So that is what has made these option prices so ridiculously expensive. So ridiculously expensive. In fact, let's take a look here. I want to look at next week. So just going out about a week or so at the money options in GameStop. So GameStop today, folks, closed right around $49 after a wild day. So if we look at the 49 calls, the 49 puts expiring next week, we can see if we add those together, let's call it $33 rounded off. What is that telling us? That's telling us that with the volatility that's in the marketplace right now, with the expensive premium that's in the marketplace right now, the option market is pricing in that GameStop, a $48, $49 stock, is expected to move $33 by next week expiration on May 24th. That is just insane. $33 on a $48 stock. So what that tells us is the market is pricing in with a 68% probability. 48 plus or minus 33, we're looking at an expected range going out to next week. In 1 week, $15 up to $81. Okay, I know I don't want to play that. I don't trade in the speculative market. This is way out of my range right here. Now, there are people that are just going to, buy call options, buy put options, and hope to get those massive moves one way or the other. But let me show you something here, guys. Okay, let me go back to our volatility chart here. Okay, this is right here, the implied volatility in GameStop options and what has happened over the last couple days. We can see this massive, massive increase from about 168 up to 350. Now, what does that actually mean, right? Most people don't look at implied volatility. Most people don't understand how it works. I'm going to break it down real easy for you. Okay. Again, implied volatility comes down to what are people willing to pay or willing to sell an option at. And you can see with the spike here, people are willing to pay a lot more. But what happens over the next week or so if volatility in GameStop just kind of retreats back a little bit? And let's say it doesn't stay up here. Let's say it comes back even to the 200 level. Let me show you what that does to pricing here. Okay, let's go back to the same strikes we looked at just a little while ago. So right here, the 49 call and put expiring next week. Add them together, it's about $33. Now, right here, these numbers right here, these 500 plus numbers you see, that's the implied volatility measurement. Okay, that is really reflective of the massive amount of demand. Now, just like many of you might know what delta is, the delta of an option, which represents how much the value of an option will change as the stock moves $1. There's another Greek out there, another one of those Greeks that we talk about called Vega. Okay, Vega measures how much the value of an option will change as implied volatility moves 1 percentage point. Okay, so the Vega of these options going out next week, the at the money options, you can see here right about 2.9. That means it's about 3 cents. Okay, 3 cents per 1 percentage point that the implied volatility moves. Okay, so 3 cents per 1 point of implied volatility move. Okay, now what happens? That doesn't seem like a lot, right? 3 cents, who cares? 3 cents. But what happens if we see this massive, massive spike in implied volatility right here, come back and just normalize even a little bit? What if that volatility comes down to 250% instead of the 500% it's trading at right now? Let me do some simple math for you guys. And let me show you, okay, let me show you why you have to be so incredibly cognizant, so incredibly aware of where the premium levels are, where implied volatility is. Okay, remember, we're right at about 530, 525% implied vol. If I lower that, okay, if I lower that, and let's just call it by 250 points. So let's say this implied vol goes from 530 down to 280. And that's all, again, remember, that's all based on supply and demand. Let's say that goes down to 280, which is still incredibly, incredibly ridiculous. Okay, remember, we've got the Vega of 3 cents. Once again, Vega tells us how much the value of an option will change as implied volatility moves 1 percentage point. If vol comes down 250 points, okay, and it's 3 cents per point, that is a total change in the value of $7.50. So that option right now, this call option where we're looking at a price of $16 on the close today, even if the stock doesn't move, but the volatility comes in, okay, that thing's going to go down to about $8.50. Now, you don't have to take my word for it, but I'm going to show it to you right on the screen here. Let's manually put in here this vol down at 280. Okay, and look what happened to the price of this option. It went down by $7.50. Remember, it was $16 before. Now it's $8.64. So is it exactly $7.50? No, we're rounding things off. But you can see what I mean here, that you need to be careful when you're trading options, understanding implied volatility. How long is this meme stock mania going to last again? I have no idea, folks, but you can be sure that I will keep you updated, and we will be watching how these options trade over the next week or so. Thanks for tuning in, everybody. We'll see you on the next one.